Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Sofi stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 9.6 billion market cap. They're trading at $9.01 a share and they have 1.1 billion shares outstanding. Sofi provides financial services in the US, Latin America, and Canada. It operates through three segments: lending, technology platform, and financial services. You can get a loan from Sofi, open a savings account, etc. It operates as an online bank. They offer many types of loans, including personal loans, student loans, and home loans. The company has an investment platform that provides access to trading and advisory solutions. They also offer Sofi credit cards that provide cash back on every purchase. And something they added that not many people realize is they offer insurance. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. It is hard to look at free cash flow for banks because they borrow a lot of money to fund their loans. So it looks a bit wonky, over -7 billion in 2022 and 2023. Net income and revenue are a more reliable tool than free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. -500 million and -200 million. Revenue is a sales for the company, and that looks really good. It goes from 1 billion to 1.6 billion, up 60% into 2022, up another 34% into 2023, up 10% into the trailing 12 months. So they have the highest revenue ever, 2.3 billion. Banks generate revenue from many sources, but it's mainly from the interest spread on the loans. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows, past year 4, that's 20 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $17 billion. We divide that by 1.1 billion shares. And we get a calculated stock price of $16. They're trading at $9, so they're trading at a 44% discount. It's a buy according to the model. I did a video just 3 months ago in July. They were trading at $7.47. My valuation was almost the same at $16. So the stock has come up since then. Still not at my target. But when I do a video, I say it takes about a year to hit my target, assuming I hit it. There are 44 companies in the same industry as Sofi, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 141 million in CapEx, a little less than the average. When you think of CapEx, it's usually fixed assets, like a building or a vehicle. But companies also capitalize software. If they acquire software from another company, they may capitalize on a balance sheet and then pass through the expense periodically onto their income statement. Or some of the CapEx could be real estate. Maybe they bought a building for their headquarters. A really good debt to equity ratio, 0.5, a lot better than the median average. For every dollar of equity, they have 50 cents of debt. They're one of the few companies that do not pay a dividend. It seems like OneMain always pays a high dividend. Look at that, 8.6%. Sofi is by far the worst in free cash flow, -2.8 billion. They rank 9th in market cap. The three monster companies who have been leading this industry for decades, Visa, MasterCard, and Amex. Those three are the biggest by far. PayPal is 4th. Maybe they'll catch up, especially with Venmo. Sofi has a good price to book. They're trading at 1x book value. Book value is on your balance sheet. It's assets minus liabilities. It's a value of the company according to the balance sheet. We can't look at that PE, negative earnings. We can't look at that price for free cash flow, negative free cash flow. Price to sales is a little worse than the average, 4.1. That means they're trading at 4 times revenue. Market cap is 4 times the revenue. And we can't look at a 5-year annual revenue growth rate. They have not been public that long. So to summarize, I have them trading at a 44% discount. I give them a ranking of 6 out of 10. I really like this industry. I'm invested in Nubank, the Brazilian fintech, and I'm up by like 250%. So much better results than this company. So it seems like this stock has a lot of upside potential. Banks are not going away. Banks are a vital part of our economy. Online banking will get bigger and bigger in the future. Brick and mortar will not go away. but online banking should be growing at a faster rate. Ratio is 2 out of 10. We can't even look at 2 out of 4 ratios. And financial is 4 out of 10 because their free cash flow looks so awful. Revenue looks real good, up 136% since 2021. Let's take a look at their second quarter presentation slides. One of the best indicators for a tech company, I know it's a bank, but it's kind of like a tech company, is number of members or users or whatever term you use. They use members. Because even if a company's losing money, if they're growing their membership base, eventually they should break even and start to make a lot of money. Companies like Amazon and Meta did this really well. So they only had 1 million members in the first quarter of 2020. Now they're getting close to 9 million, and it grows every single quarter. They never have a down quarter. Although the growth is getting smaller, they were growing at triple digits, over 100%. Now they're growing at 40%. But it's hard to double your members when you have so many millions. They added the most members in the third quarter of 2023, 717,000. This most recent quarter is their second biggest in terms of new members, 640,000. But the percent is a lot lower because the base is so much higher. They only added 430,000 members in Q1 2021, but that was a 110% growth because you compare that to little under 1.1 million. So when you compare 1.1 million to 2.3 million, that's a growth of 110%. But in this current quarter, Q2 2024, when you compare 6.2 million to 8.8 million, that's a growth of 41%. But a lot more members, 200,000 more members, 430,000 compared to 640,000. Some members only use one product, like a loan. Some members use 2 products, like a loan and a savings account. Some use 3 products, insurance, a loan, and a credit card. And of course, some members use many products. So the 8.8 million members are using 13 million products. So each member is using maybe 1.5 products, on average, of course. And that's also grown each quarter from 1.4 million to almost 13 million. And the growth is subsiding. It was 121%, now it's 36%. And their best quarter again was Q3 2023. They added over 1 million products. They acquired Galileo, which added a lot of new accounts as well, 158 million. Galileo is a credit card processor. They also offer credit cards and various other digital payments. And that pretty much goes up each quarter. There was only one quarter with a decline, but overall it's going up. It was 30 million in Q1 2020, now it's 158 million. And the growth was getting low, down to 10%, but now it's back up to 23%. So when you compare Q2 2023, the 129 million, to Q2 2024, that's a growth of 23%. We all know the main way banks make money is lending. They have 1.8 million lending products. So their lending products include if somebody wants to buy a home, a mortgage loan. If somebody wants to buy a car loan. If somebody wants to go to school, they get a student loan. Those are the main ones, but there's many other types of loans. There's personal loans if you just want to go on vacation or fix up your house. And that's gone up as well each quarter from 900,000 to 1.8 million. Everything's improving except the stock. It's quite the conundrum, I know. Financial services products, 2.2 million to 11 million. This includes a savings account, credit card, insurance. You want to keep an eye on NCL, net cumulative losses, for any bank. If a bank has really low losses, their credit standards are too tight. They're not lending enough. And if the losses are too high, the credit is too loose. They're lending too much. So you want to get that sweet spot. You don't want it too high or too low, because if it's too low, you're not making much money. You're limiting your possibilities to lend. It's okay to add a few percentage points as long as you're lending a lot more. And those larger number of loans can absorb the losses. The gray line right here is 2017. Loans that were originated in 2017. And you could see the losses got up to 8%. This reddish kind of line is Q4 2022 loans, and that's up to 5%. Of course, the newer loans have lower net cumulative losses because they haven't had an opportunity to default yet. The 2017 loans are much older, so the losses are going to get higher because as loans age, people default. Newer loans, people haven't defaulted yet. They originated 35 billion of loans between Q1 2020 and Q1 2024. The unpaid balance is 15 billion, so 44% of the principal is remaining. Losses 1.2 billion. which is 6% of the paid off balance or 3% of the original balance. Here's a look at their net revenue the last 9 quarters. It's highest in Q2 2024, almost 600 million, almost identical to Q4 2023, and it grows each quarter between 22 and 58%. Some banks have 90% of their revenue from the interest spread on loans. Other banks, it's half their revenue from the interest spread, half from bank fees. Adjusted EBITDA, 138 million. That also goes up each quarter. And here's their EBITDA margin, adjusted EBITDA over revenue. So their margins are 23%. It was highest in Q4 2023, 30%. The way you get 30%, it's 181 million over 594 million. Their guidance for the second quarter was 555 million to 565 million. They crushed that, nearly 600 million. That's always good when you beat your guidance, when you beat your targets. Adjusted EBITDA, they also beat 138 million. The higher end was 125 million. And GAAP net income, they also beat quite a bit. The higher end was 10 bucks. It's 17. Also EBITDA margin, the high end was 22%. They actually hit 23%. Here's 2023 guidance. Revenue 625 to 645 million. Let's look at Q3 2023. In Q3 2023, it's 530 million. So if they hit those targets, it'll be a nice growth. Adjusted EBITDA, 160 to 165 million. That's the forecast for the third quarter. Most companies report third quarter earnings in mid-November. Assuming the third quarter ends 9/30, a company usually reports 6 weeks after the quarter end. GAAP net income, 40 to 45 million, and diluted EPS, 4 cents. Here's 2024 guidance. Net revenue growth of more than 80% versus 2023. 80%, that's a nice growth. Their revenue grew 60% in 2022 and 34% into 2023. So 80% is massive. Lending revenue to nearly double from 2023, a growth of 95%. They expect net income to be 180 million for 2024. Adjusted EBITDA, 610 million. Total capital ratio over 16%. That's regulatory capital divided by risk-weighted assets. Under Basel III, all banks are required to be at least 8%. They're targeting for 16%. Here's a breakdown of their revenue. They think revenue will be 50-50 between lending products and the combination of tech platform and financial services. Here's 2023 actual next to the 2024 guidance. You can see the actual net revenue was 2.1 billion. They're expecting over 2.4 billion. EBITDA, a little over 400 million to 600 million. They had a net loss in 2023. They expect net profit of 180 million. Tangible book value, 330 million to 900 million. Tangible book value excludes intangibles like goodwill or patents. Let's look at a stock on Simply Wall Street. Its last price, 9 bucks, 9.2 billion market cap, up 7% in the past week, up 11% in the past year. Here's the stock price since they started trading. It looks like they IPO'd at around $10, and almost all SPACs start at $10. A SPAC is when a public shell company acquires a private company. So the shell company acquired Sofi. And that was in December 2020. After 2 months, it hit its highest point ever, 26. And then from February 2021 to November 2021, it went down, then up, then down, then up. So since the end of 2021, it's done terribly. It got real low to a little over $4. That was the end of 2022. Then it did break through 11 in July 2023, then came back down again. But it looks like it's coming back up. So if you got it in August 2024, you'd be up around 40% or so right now. We all know the federal funds rate was decreased 50 basis points in September. A lower federal funds rate is a big help for a bank. Will they cut the rate again in the next quarter? Let me know in the comments. What do you think? The next federal funds rate meeting is November 6th and 7th, so we'll find out then. Who let the bears out? Simply Wall Street's at 244. They say the stock is 270% overvalued. 15 analysts priced this stock at 873, a little less than the trading at. Here's their future free cash flow targets. 500,000 for 2024, 600,000 for 25, 800,000 for 26. Here's their revenue since 2017. It was 500,000. It came down to 270 million. That was in 2018. But then it's pretty much been a steady growth since then. 270 million, A year later, 440 million. A year later, 560 million. That's December 2020. Then it nearly doubled to 1 billion for 2021. Up 50% to 1.5 billion in 2022. Over 2 billion in 2023. Now it's 2.3 billion for the trailing 12 months. Here's their debt since 2018. It was 6.6 billion. And that was the highest point. It did get to 6.5 billion in 2023. Now it's down to 3 billion. Debt is all over the place with banks because they need to fund their loans. If they don't have enough money in deposits, they need to go out and get the money. They usually can borrow from the government or use traditional debt. And here's their equity. It kind of crisscrosses their debt. Right now, their equity is a lot higher than their debt. Equity of 5.9 billion, debt of 3.1 billion. And this green line is their cash. They have a lot of cash on the balance sheet, 2.4 billion. The CEO's salary went from 200,000 to 1 million. Total compensation, 18 million. His tenure as CEO is 6.6 years. There's been insider buying and selling. The government of Qatar is a big shareholder. They sold 20 million shares. Total insider sales are much, much higher than buys because of that one sale by Qatar. Qatar is a really wealthy, beautiful country. It borders Saudi Arabia. 57% of the company is owned by the general public, 42% by institutions, and 2% by insiders. The biggest shareholder is Vanguard at 8.5%, then BlackRock at 4.3%. Silver Lake, the Menlo Park private equity firm, 3%. ARK Investment, Kathy Woods, Morgan Stanley. The big Japanese investment company Nikko, 1%. The CEO, 0.85%. Citigroup, 1/3 of 1%. And their employee count went from 1,800 to 4,400. And the ticker trades on the NASDAQ, Mexican Bolsa, and Deutsche Börse. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.